Hey guys, I am Deric. Welcome to my channel. In this video, I'm gonna explain to you the basic concept of mutual funds. Mutual fund, aka unit trust, is an investment company that invests its unit holders' money in a diversified portfolio of securities. Unit holders are the investors of the mutual funds. Investors own a share of the fund proportionate to the amount of the investment. The following is a brief history of the development of mutual fund industry. In 1924, mutual fund first started in the US. In 1959, the first mutual fund company was born in Malaysia, named as Malayan Unit Trust Limited. In 1993, the first Sharia-compliant fund was launched by Arab Malaysian Unit Trust Berhad. What are the attractions of mutual funds? First, portfolio diversification. Owning numerous securities reduces risk. By spreading out the investments over a wide variety of industries and companies, unit holders are exposed to a lower level of risk. Second, professional management. Unit holders do not need to manage the investments day to day. Professional fund managers are the expert. They can manage better on your behalf. Most mutual funds allow investors to start with a small capital amount. Some mutual fund companies even do not have any minimum investment requirement, which means you can start investing with any amount of money. After making the initial investment, additional units can be purchased in small amounts as well. The services offered by the mutual fund companies are also appealing to many investors. These include automatic reinvestment of distributions, withdrawal plans, and exchange privileges. In addition, mutual funds offer convenience. They are relatively easy to buy and sell, due to the feature of high liquidity. The funds handle all the paperwork and record-keeping of investment transactions. Also, it's easy to track the prices of mutual funds. Of course, mutual funds are subject to some drawbacks. One of the biggest disadvantages is that mutual funds can be costly, as they involve substantial transaction costs. Investors are required to pay commission charges for purchasing load funds. Investors are also required to pay a management fee annually for the professional services provided. It is deducted directly from the total value of the mutual funds. Another drawback is that some mutual funds achieved lower than market performance in the past. It is difficult for mutual funds to consistently beat the market, which means it is hard to earn above average return consistently for the investors. Most of the time, many mutual funds just keep even with the overall stock market index. That means the return of mutual funds is almost the same as the average market return. Next, let's look at the structure of Unit Trust Scheme, UTS, in Malaysia. A UTS is a non-incorporated collective investment scheme, formed for the purpose of pooling the savings of investors, with the intention that those savings be invested and managed for their mutual benefit. In short, UTS is the mutual fund product. The operation of each UTS is governed by a deed, which names its Unit Trust Management Company, UTMC, and Trustee, and details the way in which that UTS is to operate. UTMC is responsible for administering the operation of UTS, including promoting and selling the mutual fund. Whilst a trustee is appointed to supervise the operation of UTS, and to safeguard the assets and investments of UTS. In other words, the UTS assets are held by the trustee, on behalf of the investors. The trustee is responsible for approving and monitoring all financial transactions, holding title documents of all UTS assets, and collecting all income entitlements on investments held. That's a way to protect the interest of the investors. Unit holders are the investors of UTS. They supply the capital as a pool of money to purchase a portion of UTS. Then, UTMC will use the unit holders' money to invest in the underlying authorized investments. For the return earned by the UTS, either capital gain or dividend, UTMC will return it back to the unit holders as distribution. In the process of investing, unit holders are required to pay fees to the UTMC and Trustee. Next, let's compare the differences between open-end and closed-end funds. Open-end funds regularly receive new infusions of cash from investors, and the funds use that money to purchase a portfolio of securities. When investors pay money to purchase an open-end fund, they receive new shares in the fund. There is no limit to the number of shares that the open-end fund can issue. As long as the investors pay money to purchase the fund, the portfolio of securities will grow, which means the size of fund will grow. The purchase and selling price is determined by the net asset value, NAV, of the fund. NAV can be calculated by taking the value of all securities, minus the liabilities of total shares outstanding. All purchases and sales are completed at the end of the day, after the stock markets have closed. That's why open-end funds usually calculate their NAV at the end of each day. On the other hand, closed-end funds operate with a fixed number of shares outstanding, and do not regularly issue new shares of funds. Closed-end literally means that the fund is closed to new investors. At its inception, the fund raises money from the investors by issuing shares, and then that pool of money will be invested in different securities. New investments will not be permitted, while the existing investors will not be allowed to sell the fund back to the fund company as well. In short, closed-end funds have a limited number of shares. From the fund company's perspective, it doesn't have to worry about cash inflow or outflow, as the capital at their disposal is fixed. So closed-end fund managers don't need to keep cash on hand to satisfy the redemption requests from investors. Only the initial offering occurs between investors and fund company. The investors may only buy the initial offering from the fund company. If the existing investors want to sell the closed-end funds, it has to be done in a secondary market. Subsequent trades of closed-end funds are done in a secondary market, similar to the common stock market. So, if you want to buy an existing closed-end fund, you can only buy it from the secondary market, that is to buy from an existing investor, but not from the fund company. Similarly, if you want to sell an existing closed-end fund, you can only sell it to another investor in the secondary market, but not to the fund company. For a closed-end fund, purchase and selling price is determined by the supply and demand of the fund. Closed-end fund investors trade their shares during the trading day at the fund's current market price. In closed-end funds, the fund price in the secondary market usually does not equal to the fund's NAV. When a closed-end fund's price is below its NAV, the fund is said to be trading at a discount. When the fund price exceeds the fund's NAV, the fund is trading at a premium. Next, exchange-traded fund, ETF, is a relatively new form of open-end fund investment. ETF is a basket of securities, designed to track a specific market index. It is similar to index mutual funds. ETFs can be traded like individual stocks on stock exchanges. So investors can buy and sell ETFs any time of the day. ETFs have low management expenses, due to limited trading by investment advisor. There are some examples of ETFs, such as Diamonds tracks DJIA, Spiders tracks S&P 500, Cubes tracks NASDAQ 100. In addition to open-end, closed-end, and exchange-traded funds, the following are some other types of investment companies. First, real estate investment trusts, REITs. REITs are a type of closed-end investment company that invests money in mortgages and various types of real estate investments. It is like a mutual fund, as it sells shares of fund to the public and uses the proceeds to invest in a portfolio of real estate investments. So the investors own a part of the real estate portfolio held by the real estate investment trust. REITs are attractive to the public because they provide high dividends, along with capital appreciation potential. There are mainly three types of REITs. First, property or equity REITs, which invest in shopping centers, hotels, apartments, office buildings, and other real estate. Second, mortgage REITs, which invest in mortgages. Third, hybrid REITs, which invest in both properties and mortgages. Next, hedge funds. In fact, hedge funds are not mutual funds. They are totally different types of investment products. Hedge funds are usually set up as in the form of private limited partnerships. Therefore, hedge funds are not regulated by mutual fund regulations. General partner runs the fund and takes 10 to 20% of the profits, whilst limited partners are the investors. Hedge funds can be sold only to accredited investors. For example, the individual investor must have a net worth of more than $1 million and/or an annual income over $200,000. Therefore, hedge funds are very restrictive, as they limit their investors only to those individuals with very high net worth. In order to preserve capital and to deliver positive returns to the hedge fund investors, hedge fund managers use various arbitrage strategies to lock in profits, which involve both long and short positions. They also use options, futures, and other derivative securities or complex strategies to ensure stable returns for the investors. Generally, mutual funds can be categorized as load or no-load funds. Load fund is a mutual fund that charges a commission. You need to pay the commission to the mutual fund company when you buy a load fund. The commission is known as sales load or sales charge, commonly falls within a 3 to 6% range. No-load fund is a mutual fund that does not charge a commission. It is free simply because the return of no-load fund is much lower than the load fund. Remember, there is no free lunch in the world. Low-load fund is a mutual fund that charges a small commission, typically ranging from 1 to 3%. Back-end load is a mutual fund that charges commissions when you sell shares in a fund. Some other fees and costs are also the important consideration before you buy mutual funds. Management fee. It is charged annually by the fund managers, who administer the fund's investment portfolio, generally 1 to 2% of the NAV. Trustee fee. It is charged annually by the trustee for the custodial management and administration of a fund's assets, that is around 0.04 to 0.1% of NAV. Switching fee. It is only applicable if you switch from one fund to another. Some other costs that you may incur, such as brokerage fees, custody fees, taxes, accounting and valuation fees, audit fees, administrative costs, etc. Generally, mutual funds can be used in a variety of ways. First, accumulation of wealth. This is probably the most common reason for buying mutual funds. The investors use mutual funds over the long term to build up their investment capital. Second, storehouse of value. The idea is to find a place where investment capital can be fairly secure and relatively free from deterioration, yet still generate a relatively attractive rate of return. Third, speculation and short-term trading. Some investors have found that mutual funds are attractive for speculation and short-term trading. One way to do this is to aggressively trade in and out of funds as the investment climate changes. Other investors might choose mutual funds as a long-term investment, but seek high rates of return by investing in funds that follow very aggressive trading strategies. Alright, that's all for this video. Thanks for watching. See you in the next one. Bye.